Hey everyone, Andy Tuttle here with the Tuttle Group, bringing you this week's market update. Let's dive into what's happening with interest rates, home buying, and of course, how it all affects you. Last week, we talked about how the January jobs report could move interest rates. Remember, stronger jobs, typically rates go up, weaker jobs report, rates go down. So what happened? The Bureau of Labor Statistics, BLS, reported 143,000 new jobs below the 170,000 jobs estimate. But revisions from past months added another 100,000 jobs, and that balanced things out. Then the media made a fuss over wages jumping 0.5%, which could be inflationary, and that's why mortgage bonds sold off and rates ticked up. But let's dig a little deeper. Hours worked dropped 0.2 hours per week, and average weekly earnings were up just 0.2%. It's not exactly a wage boom, and when you adjust for lost hours, it's like the economy lost nearly 1 million jobs in output. Then unemployment dropped as well from 4.1% to 4%, but there's a catch. The labor force grew by 2.2 million people, mostly due to new census data. Over 2 million new workers were added from immigration, and that skews the numbers. And remember, the BLS only surveys 27% of employers. You get low response rates, especially from struggling businesses. This could mean future revisions. So the bottom line here is the report had mixed signals, some strength, some weaknesses. It was a little cloudy. The bond market reacted negatively, but things could settle down, and we'll be the first to tell you if they do. All right, let's talk inflation directly, because when it drops, mortgage rates generally follow. The Fed's target is 2% on inflation, and the Fed's favorite inflation gauge is the Consumer Price Index, CPI, and that report drops on Wednesday. So here's what we're expecting. Headline inflation includes food and energy, should land in a range that keeps the year-over-year rate at about 2.9%. But core inflation, which excludes food and energy, is expected at 0.3% month over month, which means it could drop the year-over-year number from 3.2 to 3.1, and we think we could get even better numbers because shelter costs, which are almost half of CPI, have been a sticky part for inflation, and it's finally catching up with reality. So we could see inflation come in lower than expected and closer to the Fed's 2% target. Bottom line, if CPI comes in cool, mortgage rates could improve. If not, we're going to be stuck in this range a little longer. Either way, we'll break it all down for you, so stay tuned for more updates on that. Here's the game plan overall. If you're under contract, you can start the week floating, but watch Wednesday's CPI report. If you're house hunting or thinking about refinancing and trying to find the right spot, rates are trending in your favor, but expect some volatility, just like that family game night that always seems to get out of hand, especially with us when you're playing taco gack, goat cheese pizza. My goodness. We'll keep you posted every step of the way. If you found this helpful, please smash that like button, and as always, be the Buffalo. Thanks for watching.